Lesson 5. Accumulation and Consumption Phase Simulation. Hello and welcome to another lesson in which we will go another step further. At the beginning, we will just make a quick reminder so that we will build a simple passive portfolio, which we will use later to run several capital accumulation phase simulations, which means that rather than having a starting capital and do nothing for years, just investing it, we will have a small capital at the beginning and then we will contribute to that portfolio regularly. And probably for most of us, if we don't inherit a huge capital, this is more practical approach because probably most of us start with smaller capital and then we contribute to our portfolio when we work and when we save money and when we invest portion of that money, and that's how we build our portfolio normally over the years. And we will see how we can achieve that using System Trader application. On top of that, we will try to answer the question when we can say that we are financially free, which means that we don't have to work anymore, at least just for money, and that the capital we already have in our portfolio is enough to satisfy all our life needs. So for example, we just say that, okay, I have so much money that now I will just withdraw from that portfolio on, let's say, monthly or yearly basis, and that will be enough till the end of my life. And how to do it and how to estimate if it's the right moment to do it and what strategy to take when it comes to capital distribution, because this is very important. No one would like to have the case in which we are having not enough money. No one would like to be in the situation in which our portfolio is reaching zero. Okay, so let's move to the application. And as I mentioned at the beginning, let's build a simple passive portfolio. Click on the button Add and Pie Chart Investing because that will be passive portfolio. And let's say that we want to have a portfolio 80-20. Which means that we will have 80% of global stocks and 20% of bonds. And also, just for our purposes, let's say that we will build our stock portion using two ETFs. The first ETF, and it will be ETF registered in the United States, will be URTH, iShares MSCI World, which is the ETF covering stocks from developed markets. So let's put it here and let's make it 70% in our portfolio. Now let's put another stock ETF now for emerging markets. Again, American one. And here put emerging. And here we go, VWO, Vanguard FTSE Emerging Markets ETF. And let's set it for 10% in our portfolio. Okay, and now we have to put the last bit in our portfolio, which is bonds. And for that purpose, let's use ETF, which is having 10-year treasuries, IEF, 7 to 10 years treasuries, 20%. And here we go. We have a portfolio 80-20. But because we have ETF here, the data for ETFs is going back 10-20 years. But we would like to see how our portfolio, when we accumulate, when we then distribute from that portfolio, is performing over the matter of decades, not years. Therefore, we have to set also the backfill data. And for that purpose, let's click on that button here, and in the System Trader, let's set the backfill data for the developed markets. And of course, we could use the data coming directly from the index provider, MSCI. However, that index provider is not going that far because basically our data could go at the best till the 80s of the previous century, which is not enough for us. Therefore, we will use a different data built into the application, world stocks, developed countries. And this data is going to the beginning of the 20th century. Okay, let's do the same thing for the emerging markets. And here we have the emerging markets and same story for the bonds. So let's set the backfill data for 10-year government bonds. Okay, and for now we have portfolio set up correctly. But now, rather than having a huge starting capital, as I told you at the beginning, let's simulate the accumulation phase. So let's say, for example, that we have a small starting capital, $10,000, but on top of that, we will contribute to our portfolio $1,000 every month. To do so, let's go to the cash flows, and here let's select contribution. And now, in the contribution variant, we have a few options. When we contribute to our portfolio new capital, we can at that time do the full rebalancing. But this is not a good approach because basically, especially on a taxable account, it can cost us a lot of taxes. But we can do rebalancing, meaning that we will use our contributions to rebalance our portfolio, or at least to the extent it's possible, because maybe the portfolio is deviated so much that even contributions are not enough to rebalance the portfolio. But at least we decrease the probability of future rebalancing of our portfolio, which is a very good approach. Other two possibilities here is current proportions, which means that we will contribute capital to our portfolio based on the current proportions, or we will add to the portfolio capital based on the model proportions. But as I said, rebalancing, this is the best approach. And by the way, you have also the description here, and I recommend to read it when you are in doubt. Let's say that we want to contribute, and the contribution frequency will be monthly every month. And the amount of contribution will be $1,000. But the thing is that if we build our capital for decades, $1,000 today is not exactly the same as if it will be in, let's say, 10, 20, 30 years. And it's the same story that $1,000 20 or 30 years ago had a totally different value than today. Therefore, we want to increase the amount we deposit to our portfolio, we contribute to our portfolio by inflation, which means that over the years, our contribution will be, in value terms, at the same level, $1,000. But if we want to increase our contributions by inflation, we have to set also the data for inflation. And in that case, we will use the CPI from United States, US Consumer Price Index. Let's set it here, and we are done. Let's save it. And for the beginning, let's start our simulation from year 1982 till 2021. And let's press button test to see what's the outcome. Ta-dam! Here we go. As we can see, we have 40 years of simulation, and from the starting capital, we have the ending capital almost $7 million, but this is in nominal terms. In real terms, it's $2.3 million. And this is important because someone could say that starting capital, $10,000 in 1981 or 1982, in fact, was a totally different capital in terms of value than today. He or she is, of course, right. But if we adjust the result afterwards to inflation, then if we look at this result, the final capital adjusted for inflation, then everything is fine. Of course, this capital is much bigger, but it's not relevant to us because the value is not exactly what we could achieve if we would really invest $10,000 in terms from 1982. Therefore, what we have after 40 years in terms of the purchasing power is $2.3 million. Also, what you can see here is that the sum of payments to the account, the contributions, is almost $1 million. And it can be pretty strange because we were contributing only $1,000. Although we were doing for 40 years, that wouldn't give us probably $1 million. How is it possible? Well, if we go to the rebalancing history, we can see that, for example, in 1982, we were contributing indeed around $1,000 per month. Of course, when the time flies, this amount slowly is increasing. And here in 1983, we already see $1,071. If we move to the year 2002, it's already 1,900, almost 2,000. And when we arrive to the year 2021, we have the monthly contribution at the level of almost $3,000, 3 times more than 40 years before. Why? Because this contribution capital was increased by inflation. Let's see on the chart here, and as we can see, here is the nominal terms and here is the real terms. And of course, it grows rapidly because we are contributing over the years. Let's go back to the summary and let's try to answer the question, is it enough money for us to say that we are financially free? Well, that depends what needs we have. For example, if we would say that $80,000 is enough for us to satisfy our annual expenses, then fine, yes, we could say that we are financially free if we apply the so-called 4% rule. Why? Because the 4% rule says that if you have capital, which 4% allows you to satisfy all your yearly annual expenses, then you are free, because even if you adjust that amount in the subsequent years by inflation, you can do it actually forever. Or at least the research which was performed on the American stocks is telling us that after 30 years, it's very unlikely that applying the rule 4%, we will have zero in our portfolio. So in our case, if we would need 80,000 per year, and this amount is just out of the blue, maybe for someone 30,000 is enough, for others maybe 100,000 is needed. So it's very individual. But let's say that we need 80,000 per year. That means that if we want to apply the 4% rule, we need to have at least $2 million in our portfolio, because then we can take out $80,000 in the first year, and then we can adjust that amount by inflation in the subsequent years. And it's very unlikely that we will have zero in our portfolio after 30 years. In that particular example, we can say that we are financially free. But we will get back to that topic. But now, before doing that, let's see how that portfolio would look if we will start from the year 1942 till the 1981. And let's start. Okay, what we have here, the final capital adjusted for inflation capital now is more than twice smaller. It's $1 million. Remember, before, between 1981 till 2021, we had over $2 million after inflation. Whereas when we would start in the 40s, after 40 years, we would have only 1 million. Only, meaning that more than twice less than in the first example. Why is that? Because the markets are not really predictable and they have cycles. And also, we need a bit of luck when we are investing. And unfortunately, in that case, investor would be in trouble if he would think that $1,000 per month is enough to achieve the financial freedom after 40 years if we take into account that we need 80,000 per year. Why I'm showing that is because it's always good to check our assumptions not only on the past 20, 30, 40 years, but also going back much further. And probably in many cases, we will have a better answer to our questions when we look deeper into the data, because sometimes the most recent data is not really telling us what will happen in the next future, in the next years, but going much further in the history probably will tell us more about the future. And by the way, of course, no one knows what will be in the next 40 years from now, but it's better to keep in mind that $1,000 per month when we have $10,000 as a starting capital may be not enough to have a financial freedom after 40 years of contributions. And we have a proof for that if we go back to the years 40s from the past century. But okay, let's assume that we already have $2 million in our portfolio. And now we would like to start our retirement, and we would like to start consuming that capital. So let's go back to our portfolio, and now as a starting capital, let's set 2 millions. And now, in cash flows, rather than having contributions, let's set withdrawal. And let's say that we want to withdraw our money on annual basis. And let's say that we want to apply the 4% rule. If we have 2 millions, that means that we can withdraw $80,000 because this is 4% out of 2 millions. And also, we want to adjust that amount for inflation so that 80,000 will be not only in the first year, but also in the subsequent years during our retirement, so that always the purchasing power of our retirement is on the same level. Okay, so let's save it. And now let's start from 1941 till 1981, which we know that is very difficult period. At least when we were contributing to our portfolio during our accumulation phase, it was very difficult. So let's see how that portfolio performs when we are during retirement. And what happens here? Well, actually, we could say that we were successful, although, look, we have a starting capital $2 million, and we contributed from our portfolio over $7 million, which means that our portfolio was making some profit during that time because we withdraw multiple times more money than we had at the beginning. But on the other hand, after 40 years in our portfolio, when we adjust it for inflation, we have only $260,000. So imagine if we would have to live with our portfolio a bit longer, then we could be in the situation when it's not enough capital to have enough money during our retirement. And this is not a really comfortable situation. And by the way, look that in our rebalancing history, if you go to the beginning of our retirement, we can notice that, for example, in 1942, we were withdrawing $87,000. But that amount is increasing over the years. And for example, in the 60s, we don't withdraw only 80,000, but we withdraw much more money. For example, almost twice or even more than twice more, $164,000. And at the end of our retirement, we are withdrawing over $400,000, as you can see here, which is a lot. It's many times more than the initial amount during our retirement when we were starting our retirement. Okay, but let's now try to make that simulation for the years which were happier, let's say, on the markets from 1982 till the end of 2021. And let's see the results now. Ta-da! What we can see here. So we have again starting capital 2 millions. The ending capital in nominal terms is over $68 million, which is a lot. But in real terms, it's 23. So much less, but still many times more than the initial capital. So let's imagine that you are on the retirement for 40 years. You are taking out money from your portfolio every year. And still, after 40 years, someone can inherit from you $23 million, over 10 times more when you started your retirement, which is really great. And it's because also the investor was pretty lucky in the last, let's say, moment, because over these decades, the markets were performing much better than 4 decades before. So as you can see, really, also the luck factor is important in the investment, although maybe this statement is not very popular. And by the way, you can see here that the total withdrawal from the account was over $6 million. We had a starting capital, 2 millions, and still we made at the end almost $70 million. Of course, in real terms, it's much less, as you can see here. But okay, let's go back for a while to the first example when between 1941 till 1981, we had the situation in which we were almost close to have zero on our account. can we somehow improve that situation? Well, first of all, in order to have a wider margin of safety, we have to save more. So, well, if we have more capital and we can consume less, then of course we can have a wider margin of safety and we can just have a higher comfort that we will not be in situations in which we will have to struggle with zero in our portfolio or near zero, or we will be stressed if it will be enough for us for the subsequent years. Also, if you want to have a different approach to consumption from your portfolio, you can select a different strategy of withdrawals. Namely, rather than using the so-called 4% rule, you can withdraw percentage-wise, meaning that, for example, you would say, I will take out from my portfolio 4% in the first year, and in the second year, I will take also 4%, but from the current portfolio value, which means that if the portfolio is higher in value, I will take out more money, but if it decreased, because, for example, the market conditions are not that good, I will also have a lower retirement. So basically, using that approach, we will never be in the situation in which our money will be zero on the account. But on the other hand, we may be in the situation when we will withdraw from our account not enough money to satisfy all our expenses. So, well, there's a risk. And basically, the best approach is just to try to save as much as you can. And then basically, when you start your retirement, rather than starting with the 4% rule, you can, for example, say that I will start with 3% rule, and then it's much easier. Because, for example, if we go back to this situation with the 4% rule and we will say, rather than taking out $80,000, let's assume now that rather than using the 4% rule, we will use 3% rule. So rather than taking out $80,000 from our account in the first year, we will take out $60,000 and we will adjust that amount by inflation in the subsequent years. Let's see what happens during the tough period between 1942 till the end of 1981. As we can see, now, after 40 years of retirement, our portfolio is almost at the same level in real terms as when we were starting our retirement. So, okay, we don't have more from which someone can inherit after us, but still, we had a comfortable life at least, that it's unlikely that in the subsequent years, our account will have zero. So basically, if you consume less, then you have a wider margin of safety. And consume less in the percentage-wise doesn't have to mean that you consume less in money-wise, because rather than having the starting capital 2 million when you start your retirement, you have, for example, $3 million, then you have more comfort that you don't have to use the 4% rule, that you can decrease this portion of amount you want to take out from your account in the first year and in the subsequent years. Okay, let's look on another example. So far, we were using 80-20% portfolio, which means that we have 80% of stocks in our portfolio. But what happens if someone says, this is too much for me? I don't want to go through such a high volatility periods, and I will feel better, my stomach will feel better if I will have 60% of stocks in my portfolio. So let's build the portfolio 60-40. For that purpose, let's use our portfolio 80-20 and let's make a copy and call it 60-40. So we have it here. And now let's go to edit and adjust that portfolio to indeed have 60-40. So here we will make 50%, we will keep that 10%, and we will have 40% of bonds. Now we have the 60-40 portfolio. Okay, let's save it. And let's see what happens during that difficult period. We know that that was a difficult period for the markets. Let's see what happens during retirement it's not that bad. Actually, we started with $2 million, and then in real terms, after 40 years, we have over $700,000 in our portfolio. But keep in mind that we haven't used the 4% rule, but we used the 3% rule. Go to edit, and in cash flows, we see 60,000. What if we would use 4% rule for our 60/40 portfolio? 80,000 because we have starting capital 2 millions. Save it and start it again. Oops, and we can see a bad message. Results could not be computed. Starting capital is too low. What happened? Well, if we would continue contributing our money till 1981, in fact, we would have minus 3 millions on our account, which is not possible. So that means that unfortunately our portfolio would bankrupt because it was not enough to have it for 40 years of retirement for the 4% rule and portfolio 60/40, because there was not enough stocks and because the portfolio was, in quotation mark, too safe. Unfortunately, we couldn't just satisfy our retirement needs for 40 years. And in fact, if we would make that simulation till 1973, we can see that our portfolio indeed went bankrupt in that year. And now you can see here that our portfolio, and this is in real terms, was going to zero. So this is a bad news because still in 1973, we wanted to be on the retirement for a few more years, but we wouldn't have money for that. How to solve that issue? Well, there are no simple rules, as I said. First of all, we have to save more so that we have more money, and then we can decrease the percentage of the money we want to consume from our portfolio. Also, it's always good to be conservative in our assumptions when it comes to the future. Of course, it's nice when we look at the portfolio from the last 40 years, which were pretty, let's say, lucky for the markets. But we should not assume that the next 40 years will be as good as the past 40 years. Therefore, it's always good to keep in mind that there were the periods for the markets, like between 1940s and 1980s, in which not everything was so lucky. And if we are prepared for such a difficult period, then we can have more comfort that we will not have a difficult situation in our budget during our retirement. On top of that, I will show you also in one of the subsequent lessons that rather than having only the passive portfolio, we can also diversify our portfolio using different strategies, active strategies. And this can be really a lifesaver because maybe just because of having also more diversified portfolio, not only in terms of allocation, but also in terms of strategies, it can appear that we are safer because if the passive portfolio is struggling, maybe the active strategy is having a better time and it can save our portfolio. But more about the active strategies, I will talk in the next lessons. Thank you and see you in the next lesson. Bye bye.